Customs tariffs have now reached the skies above the Atlantic. The EU's first answer to President Trump's 30% tariff threat on European imports, a sharp 35% tax on Boeing fuselages, and Honeywell avionics. That decision will send shockwaves across the aviation industry, from aircraft leasing giants in Dublin to Boeing's assembly lines in Seattle. Will this bold move by Brussels push Washington to step back, or will it tip the global aviation balance in favor of Europe for good? Let's break down how the EU built its response and what it means for both the U.S. economy and global trade. When President Trump issued his July 12th decree proposing a 30% tariff on all EU products, Brussels was already deep in preparation. Thick files had been drawn up, and two names were circled in red: Boeing and Honeywell. Why? Because civil aviation is a core profit driver for the U.S. on the world stage. Europe's strategy targeted this industry directly. According to an internal EU document labeled Tariff Response Package A, the first counterblow is a 35% import tax on Boeing aircraft and Honeywell's high-tech flight systems. This move won't just raise prices, it will increase the cost of financing Boeing aircraft due to new penalties tied to U.S.-made fuselages. Analysts say the added upfront costs and higher delivery rates could push European airlines toward Airbus. Airbus has capacity to spare. According to its current plan, 60% of post-2026 delivery slots remain open. Documents leaked from Brussels suggest the total hit from the first phase of EU tariffs could reach $11 billion, mirroring the average yearly export value of Boeing and Honeywell to Europe. In 2024, Boeing delivered roughly 285 aircraft to Europe, with a list price around $37 billion, though discounted sales settled closer to $24 billion. Honeywell, which supplies avionics and control systems for most of these aircraft, earned about $7.5 billion in European revenue. The EU's plan proposes a 35% tariff on Boeing's fuselages, wings, and engines, and 20% on Honeywell's systems. The combined impact? An $11 billion burden. As aircraft prices rise, Honeywell's per-unit revenue climbs too, doubling the financial pain. So why was Ireland caught in the crossfire? Because Dublin hosts some of the world's largest aircraft leasing firms, which handle a major chunk of Boeing's civil aircraft financing. Thanks to favorable tax laws, Ireland controls about 45% of the global aircraft leasing market. In 2024, 4 out of every 10 Boeing planes were financed via Irish special-purpose vehicles. If tariffs make U.S. aircraft more expensive, leasing firms may pivot to Airbus models like the A320neo or A220 that would hurt Boeing and cut into Irish commission income. Ireland isn't alone. The Netherlands will also feel the blow. Amsterdam Schiphol, through Lufthansa Technik, is a key European hub for Boeing parts. Fewer orders mean slower stock turnover and tighter profit margins as inventory costs rise. Luxembourg, too, is at risk. Its cargo carrier, Cargolux, relies on Boeing's 777 freighter aircraft. A 35% tariff could tack on an extra $28 million per plane, raising leasing costs and slowing fleet renewals. But the deepest cuts may happen in Boeing's own backyard. Assembly lines in Washington, South Carolina, and Missouri have already been strained by euro-dollar shifts. Now, a 35% tariff adds another $6 to $7 million cost per aircraft for European buyers. Many will start asking, is it still worth it to stick with Boeing? Or is it time to switch to Airbus? Airbus seems prepared. It plans to add another A321XLR production line in Getafe, Spain by 2026, joining existing lines in Toulouse and Hamburg. Airbus has also opened its books to new clients, with delivery slots up for grabs. Major European carriers like Lufthansa, Air France, KLM, and Iberia are already eyeing the A321XLR as a potential replacement for the Boeing 737 MAX 10. Ryanair, too, may revise its MAX fleet renewal, depending on how the tariffs play out. Meanwhile, Brussels is quietly sharpening another blade, this time against Honeywell. Though the company also supplies avionics to Dassault and Embraer, the EU doesn't seem to care. Honeywell has 15,000 engineers in the U.S., and a 20% tax on its European sales could slash revenue from $7.5 billion to around $5.4 billion. That could force shift cuts at Honeywell's Foothills campus in Arizona. President Trump says he wants to protect U.S. jobs, but this retaliation may do the opposite. Less revenue means smaller R&D budgets and delays in developing the next generation of flight control systems. Boeing is now facing more than just tariffs. It's staring down a major R&D setback. The company urgently needs a new software package for integrating avionics to meet FAA certification standards. In short, these taxes are beginning to disrupt the entire aviation innovation chain. But the EU's counterstrike isn't limited to aircraft components. It's also going after bourbon whiskey, again. Back in 2018, during the steel tariff clash, the EU slapped a 25% tariff on whiskey, provoking an outcry from Kentucky lawmakers. Now bourbon is back on the target list. This time, the EU's retaliation digs deeper. It includes environmental compliance penalties on IBM's engine control systems and GE's turbofan subcomponents. Together with Honeywell, these form the backbone of the U.S. aviation supply chain. So when Boeing's fuselages are taxed, the impact automatically ripples out to the subcomponents. The EU's two-part strategy aims to deliver a combined economic hit of roughly $11 billion. Brussels is basing its response on Article 22 of the Marrakesh Agreement, which allows equivalent measures in cases of unfair trade. A formal warning has already been sent. If the United States fails to pull back within 90 days, the EU will implement the full package. Behind the scenes, Boeing is mobilizing its congressional connections, while Honeywell is expected to lean on Arizona senators. Still, President Trump might refuse to reverse course for fear of appearing weak. Internally, EU politics also play a key role. Germany, France, and Spain, all Airbus stakeholders, stand to benefit from the retaliation. Once Brussels passes the tariff package, Airbus will receive more orders, complete with a Made in Europe label, boosting factories in Toulouse and Hamburg. This will offer a much-needed boost to Europe's aviation sector, which is still suffering from earlier U.S. tariffs on car parts. Countries like the Netherlands, Sweden, and Denmark, which use both Boeing and Bombardier jets, may seek subsidies to offset higher costs. The EU Commission plans to allocate €1 billion from the European Innovation Fund to help airlines adjust. This money will be branded as a green transition grant to ease the cost shift caused by the tariffs. At a private briefing, Honeywell's avionics chief said that 30% of its yearly output goes to Europe, and that a sudden 20% tax could raise the cost per avionics unit by $900,000. Airbus customers like Thales or Collins might seize this opportunity to replace Honeywell entirely. Airbus already relies heavily on French suppliers like Thales and Safran, so if Honeywell loses market share, the French avionics ecosystem gains ground. In other words, the EU is calculating not just the cost of retaliation, but the strategic upside too. As debate over which EU nation suffers most continues, here's a ranking compiled by Euronews: first, Ireland; second, Netherlands; third, Luxembourg; fourth, Germany; and fifth, Denmark. Germany's exposure comes from Lufthansa and MTU's engine servicing business. Denmark risks losses through SAS's Boeing heavy fleet. If retaliation goes forward, Honeywell could lose $2 billion. Boeing might see its order book shrink by $10.5 billion. Add in $1.2 billion from affected bourbon and soybean exports, and the total first-year impact could hit $11.7 billion. What started as a political jab at European trade preferences is now a full-blown threat to American industry, especially in aviation. A 35% tariff on Boeing jets could cancel key orders for the 777X and 737 MAX. Honeywell's avionics business may face a 20% tax, pushing buyers toward French alternatives. Bourbon prices surge, hurting Kentucky farmers and tourism. Profits evaporate in Ireland, the Netherlands, and Luxembourg's aviation finance sectors. Airbus benefits from a flood of new orders and a stronger research and development base in France and Germany. If the United States doesn't ease off, the EU will roll out its WTO-backed retaliation plan within 3 months. From canal crises to aviation spats, America's protectionist playbook is now being challenged head-on. This time, Europe seems ready to punch back, hard. What do you think about all this? Drop your thoughts in the comments. And, don't forget to subscribe and turn on notifications to stay updated. Thanks for watching.